Welcome back. Look at Paytm. That stock's moved higher right now. Reported its numbers yesterday. Decent set coming in. The street liked that. The stock continued to move higher. Thereafter, the stock has been doing well. And this, in line with a lot of these new age companies that are seeing a fair amount of buying. So Eternal, for one as well, has now moved to the high point once again after seeing a big move post its numbers. So immediately after the numbers, the stock was up almost 15% in the preceding, in the following day and a half. And thereafter, we have another 3.5% movement coming in on that stock, taking its weekly gains to 21%. But one stock which is at the lower level in today's trading session is Persistent Systems, down almost in high single digits, trading with big cuts after the first quarter numbers came by. Not so good for the IT pack. Revenue growth missed street expectations, just as all the other companies reported numbers barring Infosys. Margins, however, in line with expectations. Reema spoke with Sandeep Kalra and began by asking him about his expectations from the quarter that we're in right now.
We have said it multiple times. We don't give forward-looking guidance, but if you look at our trajectory, if you look at our performance over the last 21 quarters, if you look at the order book, all of these are healthy. The pipeline is healthy. We'll let the quarter pan by. Keep in mind the macro is a little bit iffy because of the various, tariffs on, tariffs off, various things that have happened, whether it was India, Pakistan, whether it was the Iran conflict, and there is a little bit of, iffiness in the market, but we believe that should get resolved as well. So from our perspective, good performance so far, reasonably confident going ahead. I'll just leave it there.
And H2 versus H1, what's your own expectation?
Okay, so let me give you a bigger picture, and then we'll see H2, H1. So if you look at it, we have always said in the last several years, last couple of years, we want to be a $2 billion company aspirationally. Again, this is not a guidance. By FY27, we want to be at $2 billion. Now, if you do the maths, we have to compound from an yearly compounded annual growth rate at about 19%. That's our aspiration. We are currently at 18.8% on the year. So I'll just leave it there, whether it is Q2, whether it is H2, whether it is next year. If you compound it to the next 2 years, don't worry about one quarter or the other. But if you look at the bigger picture, that's our aspiration. The entire team at Persistent is working towards it, and that may include a tad bit of acquisition. So that is where it is.
But do you think 19% revenue growth that you need to achieve this aspiration of $2 billion can be achieved only organically, or will it require acquisitions? And if those acquisitions come, will they be over and above the $2 billion? And where are you looking at acquisitions?
Sure. So look, it will definitely have some amount of M&A, the acquisition part. Now, depending on the size of the acquisition, we may get there faster. We may have smaller acquisition, bigger acquisition. And to that point, look, at any point in time, we are evaluating multiple different options. We have said our acquisition strategy is twofold. One, Europe as a geography, we are currently at a 8.5 to 9% revenue clip. We have grown Europe at the company pace for the last several years, but we want to take a step change in Europe. We want to grow Europe over the next several years to 15% of our revenue. And that is basically to balance our revenue profile. And also, as we grow bigger, it's a healthy mix to have. Second part, we have said we want to be very well known for what we have always done better, the technology capabilities. So as the field of AI data is evolving, there are two pivots to that. One is the data and AI competency itself. Second is the domain competency in the verticals that we play in, which is banking, financial services and insurance, and healthcare life sciences. So our acquisitions for capability will be in most likely North America, India corridor. Our capability-led acquisitions will be in the areas I talked about. Our geographical expansion aspiration is in Europe, followed by Japan later. So any of the acquisitions in geography will be at scale to basically get us the toehold in customers in the areas, geographical areas where we are not that strong as of this point in time. Hopefully that answers you.
What's the war chest for M&A?
So look, we have $300 million of cash. We generate about $100 to $120 million every year. And we have the ability to raise money to whatever extent we want to. But again, look, our aspiration is to be the best technology services firm out there. And in our mind, the next generation tier 1 companies are not going to be defined by their revenue size. They are going to be defined by the capabilities. They're going to be defined by their ability to add value to the customers. And if you look at the journey of Persistent over the last 5-6 years, increasingly we have taken market share away from the larger companies. if you look at some of the relative sizes, the biggest company in our sector versus us, we have, if you look at the numbers, we have, by any metrics, outpaced any of the companies based on capabilities. So from that perspective, capability-led, focus there, and that's where it is.
Your margins are higher, 150 basis points on a quarter-on-quarter basis. But from here on, from 15.5%, can you expand margins? And what would Q4 exit margins look like?
Okay. So first, Reema, the margins are 150 basis points higher year on year, not quarter. So from that perspective, if you look at quarter on quarter, last quarter was 15.6%, this quarter is 15.5%. But keep in mind, there's a significant exchange rate, fluctuation that has happened. Now, if you compare the last full year was 14.7%. Now, if last full year was 14.7%, our starting point for Q1 is 15.5%. Again, we don't give forward-looking guidance, but if you extrapolate it, you can do your maths. And we have said we want to increase our margin as we go along by 100 to 200, 300 basis points over the period of time. We are on that trajectory. So I'll leave it at that.
But you've decided to defer your wage hikes. You typically give it in Q1. I mean, you typically give it 1st of July. But this time, given the macro, you've decided to wait. Take us through the reason behind that. And when do you think you will have the confidence to go ahead and give a wage hike? Or do you think this year, maybe the industry doesn't give employees a wage hike?
Okay, so two parts to it. Many people in the industry are deferring wage hikes by quarters and maybe for the full year. We are not doing that. We have just said we'll defer it by 1 year, and that is cast in stone. We are going to give the wage hikes next quarter. And if by the end of the year, if things pan out the way we want them to, maybe we will also take care of whatever we deferred. So that's one part to it. Because at the end of the day, our employees are our biggest assets. The reason why we deferred the wage hike is twofold. One, there is a tad bit of softness in the market. There's uncertainty. We just want to make sure we have a healthy company. We never get to the point where we have to lay off people. That's point one. Second, we are investing big time into AI. That is going to be our pivot into growing the company in a very differentiated manner, at a very differentiated pace, at a very differentiated profitability over the next several years. We need investments. We can't do everything at the same time. So we are trying to make sure that as we train our employees, as we invest in them, as we invest in our capability build, we are being prudent. So that's where it is. And it is not to do with the entire industry. Even when the entire industry was not giving bonuses, was giving 60% bonuses, I'm proud to say for the last 6 years, we have been anywhere between 92 to 107% of our employee bonuses on a yearly basis. So that's where it is.
Healthcare for you was a bit soft. I think it declined by about 1.9% on a quarter-on-quarter basis. What was the reason for that? And going ahead, what will drive growth for you, Sandeep?
Sure. So two parts to it. What will drive growth for us this year? Banking financial services, followed by high tech, followed by healthcare life sciences. Now coming to healthcare life sciences, if you look at the trajectory of healthcare life sciences in the last 6 quarters, and maybe when you do the analysis, you look at that, healthcare grew at the fastest possible clip in the whole industry for us. And it was at one point in time more than 60% year on year. Now, look, we have grown that sector. There are times where we are signing deals where we have to take the revenue, convert that into offshore-led as a part of the cost savings for our customers. The consolidation of that piece is happening. And as we speak, for the next 1-2 quarters, that will happen in one of the larger customers that we have. Having said that, it's a sum of parts. We are very confident. If you look at the end of the year, all the 3 segments for us, whether it's BFSI, the banking financial services, healthcare life sciences, or high tech, all of them will grow secularly. So that's where it is.
Okay, all right. That was the management of Persistent. For the time being, the stock continues to remain under pressure. Well, before we slip into a short break, a small programming note for all our viewers. As the workplace transforms, so must leadership. In the Bengaluru edition of Future Female Forward, Season 3, India's top business leaders gather to reimagine what inclusive leadership looks like and how women are powering the future of work, capital, and innovation. Catch it live on July 29th, 5:30 p.m. onwards, only on CNBC-TV18, CNBC-TV18.com, as well as on YouTube.